Hey everybody, what's going on? It is James here with Crypto Common Sense, and I have today's edition of Bitcoin Bytes. In this video, I am going to quickly cover Bitcoin. I'm also going to cover a couple of trade lessons that you can take and use in the future to hopefully make some money. In the last video, I talked quite a bit about Ethereum, and I talked about bearish retest and bullish retest. So I wanted to expand on that topic a little bit in today's video. But before I jump into the content, stop now, hit the thumbs up button. Make sure to subscribe to the channel, and of course, make sure to click that bell icon to get notifications when I release new updates. So this chart here is a DXY chart. It basically measures the strength of the US dollar. And in the last video on Ethereum, I talked again about bullish retests and bearish retests. I just wanted to show you all that that's not a concept that is specific to crypto. And it's really a powerful concept. I was, explaining this to my Discord members this morning. Trading is it's not a tough thing. It's not a complicated career. I see a lot of people that try to make it complicated. I see a lot of people who try to make it sound tougher than it is. I think it's a lot of ego. Like if you can convince everybody else something is really, really hard, then you get to feel special about being good at it. And I do think it's difficult for people to learn to control their emotions. Most people, period, have very poor emotional control. That's, what's wrong with the world today. You go out there and you drive down the street and you've got people fighting in the street because somebody, cut a corner or just ran a stop sign, or, and they're out there shooting at each other and everything else. It's just really poor emotional control in 2022. And that's what makes trading hard for most people. But if you can, spend your time finding legitimate trades versus trying to make trades appear that aren't really there, it becomes a fairly easy career. It's just a bit tedious, right? It's not fun. I don't think there's anything fun about trading. Maybe when you first start, but after a while, that fun, that new wears off, and it's just a job like any other job. Just happens to be a really good paying job if you get good at it. So if we're taking a look at this chart, this is a monthly chart of the DXY. This blue line is the 200 simple moving average, and we can see that when price moved below that moving average and moved away from it, the key being it moved away from it first, and then came back to retest it, left a wick behind. Well, that's a bearish retest. What do you do there? You look for short positions. And what happened next? If Tradingview will use the right icon here, you all saw twice I've clicked this hammer. It just keeps putting rockets. Thanks, Tradingview, you suck. Anyway, right there would be a place that you might look for a short position, and then you could erode that down, right? Really, really good trade, really good return. If you shorted on the close of that red candle, right, you'd have about a 4.45% stop. And if you got out at the bottom, it'd be a little over 5 to 1. I don't think you would erode it to the bottom. Probably would have been looking to close it back here somewhere when it started leaving tails behind. So maybe 3 or 4R, right? Great trade. You go over here, you break above it. When it comes back down, some people might say, well, wouldn't that be a bullish retest? No, it's not a bullish retest because it didn't retest it. It went right through it, closed underneath it, right? Cut right through the line. There's nothing there. That's a bearish candlestick. You wouldn't be looking for longs on a bearish candlestick, right? So yeah, get a little dead cat bounce and then continue down. Plus, in this case, your moving average is curling down, which is another negative. Now, it wouldn't stop me from taking a trade if there was a big tail left behind, but there wasn't. Go over here. What happens here? You break above it. Perfect example of what I'm talking about. It's still curling down, right? But in this case, if you look, there's a couple of tails left behind, and this would be something where you could take a small position, use those tails as a stop, right? Maybe add a little extra to it because that's a very small stop. You're talking about a 0.75% stop on a monthly chart. So maybe you throw like an extra, 0.25%, 0.5%, 1%, maybe you double the stop, whatever your trade style is. I'm not going to get super deep into that. There are some very specific ways to approach that so that you're not getting clipped. And then if you take a trade like that, let's just say 2 times the tail, what's the tail about? 0.75%, so what, 1.5%? Hit something like that. And if you did ride it to the tippy top, which again is unlikely, 14R. If you rode it to, this resistance back here, saw it starting to fail, maybe you got out here for 9R, maybe you got out on the close of this candle for 7R, whatever the case may be. Those are really good trades, okay? Really simple stuff. You don't need to be a rocket scientist to figure out, oh, hey, look, it touched this magical line and left behind a wick or a tail. That's just not a lot to it, guys. There really isn't. People just, instead of waiting for those trades, because if you're looking at this, those are 2 trades over 40 years. You're not getting those trades every single day, except you are if you're looking at 1-minute charts, 2-minute charts, 5-minute charts, etc. And if you're looking at hundreds or even thousands of assets. Again, that's why trading is tedious, because you're scanning the market. Most people who are doing this professionally are scanning, hundreds of assets. They're not trading just one asset. Now, there are exceptions, and I'm kind of a weird exception to the rule myself. So I'm being a bit hypocritical, but I'm not trying to be. I realize I'm the exception to the rule. I don't like looking across tons and tons of pairs. That's why I developed software to do it for me. But before I developed the software, what I would typically do is I would trade 1 chart or 2 charts. I would put them on 5-minute, 2-minute, and 1-minute charts. I would have multiple charts pulled up. And what I would do is I would just trade multiple setups. There's about a half dozen setups that I trade. And so I'm not waiting for just one magical setup. I have about a half dozen I could look for, and I could always find at least 1 or 2 every single day. So that's, kind of how I approach it. So there's your bit of education for this morning. Let's jump over and take a quick look at, let's look at 2 charts. This video might go a little longer than 10 minutes. First chart I want to look at is just a stock market chart. And this is going to be, let's look at the SPX, the actual S&P 500 here. All right, so I want to point this out, that there are some people who believe that we have bottomed and that we're going to make new all-time highs. And they believe that the bubble popped. I'm talking about a very special segment of people. They believe this was a bubble. They believe the bubble popped. They believe this is the bottom. Listen, I cannot predict the future. I don't have a crystal ball, and I don't want to sit here and sound arrogant and say that I know what's going to happen, because I certainly don't. What I can tell you is that if you're going by traditional technical analysis, and if you're going by traditional market cycles, that idea has no basis in reality whatsoever. All markets eventually return to their mean. That's one of the standard golden rules of trading. All markets eventually return to their mean. They either do that through a price correction or what's called a time correction. A price correction, everybody knows, it's where price crashes back to the mean. A time correction is where price simply grinds sideways, like through here, until the mean catches up to the price. Okay? So if we're using our 200 moving average just as a simple line in the sand, our mean is way down here. So you mean to tell me that one of the worst bubbles in history popped and previous bubbles moved down 50 to 90% or even greater, and you're telling me that this bubble is only going to move down 24% and that it's not even going to return to its moving average? It seems pretty far-fetched, doesn't it? I mean, if we draw a basic trend line on this market, and we're not even going to use probably what's the appropriate trend line, which would be connecting from back here to here, right? This real gradual slope, which is hard to do on this chart anyway, but let's try to do that real quick just to kind of show how absurd this idea actually is. So let's say that you were taking a trend line from even back in this area here, right? I mean, that's a pretty legit trend line starting back in 1982, connected through here, this crash in 2009, tag the trend line, right? We keep going. That's probably the legitimate trend line, which of course would mean that that market could potentially fall another 70+%, which would put it down about, 77% from the top. That's probably legitimate, right? I saw one of these legendary investors yesterday talking about he felt like this was probably going to be on par with the Great Depression type of correction or type of crash, depending on what the Fed did. I could see that. But even if we're giving it the benefit of the doubt and saying, no, we're not going to correct to that long-term trend line. We're going to correct to our much steeper, much more parabolic trend line. And we start way back in 2009, and we draw this crazy trend line that looks something like this, right? Really, maybe even something like this. But again, let's try to give it the benefit of the doubt. Say that this was an outlier. Say this is the actual trend. Even that trend line says that we have a lot further to go down. I mean, we're talking another drop of 25 to 30%, which would be a drop from the top of about 38%. I don't think it'll stop there. I don't think there's any reason that it would stop there. But anything is possible. But I mean, my point being is you cannot draw a trend line that would say this is a return to the mean, or this is a return to trend. That's not a return to trend. And the crazy thing is, in past bubbles, true bubbles, the markets do not return to their trend. They actually overshoot the trend, trade below the trend, and then come back up. So imagine that we actually go below this trend line down here. Talking about tagging, potential 2009 levels. I'm not saying it's going to happen because I don't have a crystal ball, but I'm saying that if somebody put a gun to my head and said, which one's more likely, that this continues up from here and this ends up being a market bottom and we go on a new bull run, or we return to this trend line down here, I would say this trend line down here, 99.9999999% of the time, right? This is more likely than going up from here. Now, it's potentially possible that we get another offshoot, some kind of weird upthrust, and then we crash. But I'm talking about there's actually people out there who are telling their followers that this is a market cycle bottom and that we're going to start a whole new bullish market cycle that's going to last for a number of years. I think that is next to impossible, right? Nothing's impossible, but as close to impossible as I could possibly imagine. So be very, very careful about this. I watched an interview yesterday with Jeremy. I think his last name is Grantham is how you say that. And he was one of the few guys who was calling this bubble a few years ago. He was a little bit early, about 10 months early. But he had even said then that his gauge of success was, am I getting out at a point that I'll be happy I got out at later? Not, hey, I caught the perfect top, but is it going to go lower than what I got out at? And of course, he's very, very happy now because it is, lower than where he got out at. And he's called, several bubbles in the past. For example, the bubble in Japan back in the 1980s and things. When you buy a dip of 20% in a market or 30% in a market and you think, hey, I'm getting this on sale, that's only a sell in a bull market. The difference, let's say you put $1,000 in at the tip top, and let's just say hypothetically that it did return to this trend line down here, somewhere in this ballpark. Let's not even say that. Let's just say it fell 50% from the top. Okay. So if you put in $1,000 up here, you'd be down to 500. If you put in $1,000 right here and it fell the exact same amount, you'd be down to about 590. It's almost just as bad as buying at the exact top, just because of the way math works. You don't save yourself a lot of heartache buying after 20 and 30% drops if a market continues to drop 50, 60, 70%. So keep that in mind. And now let's jump over to Bitcoin. We'll do a fast Bitcoin analysis because we're already 12 to 13 minutes in. And here we are. Bitcoin. What's going on with Bitcoin? Well, we had a monthly candle close yesterday. What's volume look like? Volume wasn't terrible. Wasn't awesome, right? Definitely wasn't awesome. Leaving behind a small wick, small tail. This is an inside candle. It's inside this bar here. I still think it's potentially possible. Remember, this is still bouncing off the 2017 highs. I still think it's possible that this thing goes up and wants to retest that $28,000 to $32,000 zone. Not a lot to say, right? Same thing I've said in the last couple of videos. Nothing has really changed. Now, I don't love the fact that it's leaving behind these wicks. So you do have to be mindful that, again, this could end up being a bear flag, could end up being something like this where it goes down, bear flag, and then your final move down, or at least another leg down. That is possible, but I haven't taken any more bearish positions. I'm still sitting in the puts that I talked about the other day, those puts for December of 2022. I haven't added to those yet. I'd like to, but I want to add to them up here. I don't want to add to them down here, right? So right now it's a very small trade. It's only about 0.1% risk of my entire trade account. If we get up here, then it'll be, depending on what the chart looks like, 1% probably. If the chart looks really, really good, then I go as high as 2% risk on those positions. But yeah, overall, I'm still rooting for that move. Just a little bounce. Give me a little bounce, let me get some shorts, get some bearish positions going, and then give me that final, kick down. But we'll see. We'll see. 4-hour chart. I don't look good. I talked about this last week, right? How these look like supply wicks, and that's a bearish sign. If you're in a long, you might want to think about getting out. This looks like a bit of a washout here, and then immediately right back down. So It's not really what you want to see there. It's not a sign of strength. And I would bet if we look at the US 100, it's probably not doing that great either. Let's see. So leaving behind some wicks. What's the daily candle look like? Looks like it started to fall, popped back up. I don't know. It doesn't look terrible. It doesn't look terrible. Just doesn't look like the bulls are. It looks like a lot of indecision is what it looks like to me, right? Like the bulls try to get something started and then like nobody picks up the torch and runs with it. And so I think it's just a waiting game. I know everybody wants to, have this idea like this is exactly what's going to happen, but you don't have an idea right now. That chart is still trying to figure itself out. Now again, you go down to 5-minute charts, there's trades all over the place every single day. You don't need to worry about the bigger time frame if you're just trading, right? It's not that big of a deal at all. Look at something like this. Like this is today's chart. Here's 8:30 where the market opened in the US, ranging a little bit before the market opened, broke below this general range back here, right? Then you leave behind this giant tail. Well, what's that saying, right? It says that when price try to move down, there's buyers just gobbling it up. So of course, once it breaks back above that level of support, this is probably a fake out. And it makes sense that you might look for long positions on a 5-minute chart and try to ride something up. Again, on a day trade, you might get something like this, like, hey, this candle closed, took out this chop, left behind that big tail. Let's give her a go. You might take a trade like this, try to get a little 2-to-1 scalp off of it. There you go. That trader's in and out, maybe 30 minutes, 45 minutes. They've got their profit booked. They don't care what happens. It doesn't matter to them where the market goes the rest of the day. If they're risking, say, they're professional traders, say they're risking $1,000, they just made $2,000. So that's the point that I would highly encourage everybody to get to. Get to the point where you don't care. Get to the point where it doesn't matter to you whether this moves up or moves down. You're just going to go find your trade. You're going to make your money for the day, and then you're going to go on about your way. Some people say, but James, I have a job, or James, I have a business. Like nobody works 24 hours a day, 7 days a week. Everyone has free time. They might convince themselves otherwise and convince themselves that they're like just the busiest person on earth. But it's just people are really bad at time management. You can make a really good side income trading in a couple hours a week if you really want to, and if you want to do this where you replace your job income, you can do that in 10 to 15 hours a week. 10 to 15 hours. Most people spend 10 to 15 hours on social media or on Netflix. Let's be honest. And of course, if you are one of these people who is either short on time or bad at time management, whatever the case may be, that is the reason that I developed my Racing Rabbit trade indicator, and you can get access to that down in the description of this video. All that being said, please remember I am some guy. I'm sitting in a spare bedroom. That means that nothing in the video is financial advice. You should always go out and do your own due diligence and seek out professional financial advice from a licensed financial advisor, which I am not, before making any type of investment in cryptocurrency, the stock market, precious metals, Forex, or any other tradable asset. This is James with Crypto Common Sense, reminding you all to please trade safe.